I came home one day and I saw a piece of paper on the door of the house right across the street. And it was a notice from a well-known, one of the big banks in the United States, saying this house is being foreclosed. And those people have moved out. What's going on when you look at Huffington Post and their lead headline is this kind of like making fun of the turn of events that's happening in foreclosures and the process of foreclosures. Millions of homes have been foreclosed and millions more are going to be foreclosed. There's that many of them in the pipeline now. A couple disclosures. Yes, I have worked for a national bank. Two of them, in fact. I worked for Northwest National Bank in Chicago. I worked for Seafirst Bank when it was a wholly owned division of Bank America. This is a Case-Shiller home price indexes, and it's a timeline from 1988 till 2010. Our presumption, even going back into the 80s, was if you bought a home, that home's value was going to go up about 5%. 8%. In this instance, for several years, it went up 12% per year, and that was compounding. Wow. But that's what we believe. We believe it always has to be that way, and so then when things turn in the other direction, it's kind of hard to let go of that. In 1985, when I bought a house, or when you bought a house, you took your idea to the bank had it appraised, checked your credit, they issued a mortgage. You probably put 10 or 20% down. The creation of the mortgage meant that they had an investment that the bank held for about, on average, 7.5 years before it was refinanced. You sold the house, moved somewhere else. It could have gone for 30 years. Most of those mortgages were 30-year mortgages. And keep that 7.5-year figure in mind. When I worked at Seafirst, we started packaging these up in bundles of 1,000, and if the average $100,000 loan, you put 1,000 of those together, you got so pretty simple process, but that pool, on average, was going to diminish by 50% in 7.5 years, right? I know some of this is, it's a little strange to grasp. And at that time, we were studying a structured asset-backed security to give sophisticated investors more opportunities to pick certain types of diversification. So tranche one, I'm going to define the word tranche in a minute. A tranche is like a component of the loan. The tranche essentially means who gets paid first. So we would sell one part of that pool at 3% interest to a third of the people who were buying. We'd sell another part of the pool, tranche two, at 4% or higher interest, could have been 5%, 6%, depending on how much risk there was in the security. And we sold a third level of tranche with a very high interest, essentially a junk bond, for 5%, 6%, 7% interest. It kind of went up and down. But questions? Okay, tranche, who gets paid first? They called it, maybe in theory, you got a tranche one had an A rating, tranche two had a B rating, tranche three had a C rating. So all bonds, securities, insurance companies are rated. In fact, after about 15 or 20 years, what developed was the rating companies had seen a very high success ratio of payback. And so they started rating tranche one AAA, tranche two AAA, and tranche three AAB. Four-way test. I'm going to ask for a show of hands, a hand vote. And the way we vote on the four-way test is, if you think it passes the four-way test, I want to see a thumbs up. If you don't think it passes the four-way test, I want to see a thumbs down. And if you're not sure, you do what I call the waggle waggle, and you go, ready? Vote. Do you think those are really AAA and AAB? Vote, vote, vote. I don't hear any How bad is this? This is a guy who testified before Congress, Richard Bowen, who is a senior VP of business underwriting for Citi Mortgage Inc. He said, in mid-2006, I discovered that over 60% of these mortgages purchased and sold were defective. because Citi had given reps and warrants to the investors that the mortgages were not defective. The investors could force Citi to repurchase many billions of dollars of these defective assets. This situation represented a large potential risk to these shareholders of Citigroup. I started issuing warnings in June of 2006 and attempted to get management to address these critical risk issues. These warnings continued through 2007 and went to all levels of the consumer lending group. We continued to purchase and sell to investors even larger volumes of mortgages through 2007, and defective mortgages increased during 2007 to over 80% of production. That's why I'm showing you the lemons, lemons, lemons. Now, when you take that stuff and you sell it to, let's say, Regents, Blue Cross, or Aetna, or the Central States Teamsters Pension Fund, you sell them billions of dollars with that. In the terms of the security, if the paperwork isn't clean, you have to take it back. So let's take a look at the state of a mortgage loan now. A mortgage broker does the deal with the bank, produces the paperwork, the mortgage is created, the bank turns it over to an investment bank, the document certification is a whole other made. The owner of securities is relying on a company called the Mortgage Electronic Recording System Company to keep all of that electronic data in a database. And if, as over a period of time, 2, 3 years, 5 years, 7 years, these people lose their ability to make the payments on the mortgage, or, as you said, they were asked to refinance, they didn't understand the documentation or the financing arrangements very well, their $2,500 payment went up to $7,000, they then can't pay. They're going into a court of law with a piece of paper that says, a robo-signer has signed this saying, I saw this paperwork, I affirm that the paperwork is clean, the judge says, looks great to me, and the foreclosure happens. Now, if she goes into court and requests to see the original paperwork, including the Truth in Lending Act paperwork, if they produce that file, but the Truth in Lending document doesn't match the actual mortgage, then something happens called rescission. Essentially, the mortgage goes poof. They're still living in the house, but they don't owe the money anymore. Rescission is good for 3 years. Now, I could ask the question, when you have your lawyer go in and do the rescission in court, does that pass the four-way test? It was just announced about 2 weeks ago. The Federal Reserve was made by law to disclose that they have actually done $3.5 trillion in lending in the last 3 years to U.S. banks, foreign banks, all kinds of entities. Does that pass the four-way test?